Could the upcoming U.S. election put a spanner in the recent equity bull run? October is traditionally a volatile month for markets, particularly in an election year, but we also said September is normally a bad month, and that didn't pan out, did it? So let's discuss what could be on the radar for investors with Robert Baharian from Baharian Wealth Management. Hi, how are you? Nice to see you again. So I think that we should be celebrating the anniversary of this bull market. I mean, it's, what is it, 2 years now?
Yeah, 2 years. So Nadine, first of all, thanks for having me again. Good to see you likewise. So 2022, we saw the vicious drop in the stock market, 25% within a period of 9 months. And in fact, October being the bottom 2022, investor sentiment was in fact the worst reading that we saw going back to 1991. And rightly so. Recession was imminent. It was going to happen, and everyone knew that it was going to happen. Unfortunately, it didn't plan out. And as they say, buy stocks when there's blood on the street. And for those that took that punt, it's played out. Last week actually was the second birthday for this, what we call the baby bull. The S&P 500 is up about 63% price only during that time. But just to put this into context for you, the average bull run runs for about 5 years, and it gained 180%. That, however, may or may not matter, and I'll talk about that in a second, but the bull market has spread beyond just stocks, and we've seen beyond just the tech sector as well. It's spread and it's come right through cryptocurrency, Bitcoin up 255% during the bottom of the market. So risk has been on for the last 2 years, but it's not only prices that have been at record highs. Forward earnings, we talked about that last week, have also hit a record high. PE ratios or price to earnings ratios have increased from about 15.3 times to about 21 times. And I've touched on the fact last time we caught up as well that this was a broad-based rally. Some numbers for you, Nadine. The S&P 500 equal weight is up 41% during that time. The S&P 500 market cap weight up 63%, and the NASDAQ up 78%. And this is really what bull markets are made of. To give you a bit more perspective, going back even further, back to 2021, May 2021, the S&P 500 is up 38% from there, from that market peak. But it is also 19% cheaper now than it was back then. How? Well, in May of 2021, we had price to earnings ratios at 33 times, and now we're sitting at 26 times. So even though the market has done what it's done, on a relative valuation basis, we're actually cheaper now than we were back then. And so you only get this with earnings growth, Nadine.
Okay, all right. And we are in the midst of quarterly earnings season in the United States. And obviously, we often follow the lead that's set there. But is there any way, it sounds like you're a data guy and you do your research, is there any way to know or to get a sense as to how long this bull run might last now that it's hit the 2 year mark?
Yeah, my first caveat is no one knows how much longer this bull market will run for. But I saw some of those charts coming up. If we can get that one back up from Bespoke, the grey lines and the blue line, that's from Bespoke Investment Group. Massive shout out to them. They do incredible work. You can see there the grey lines represent the bull runs with the historical bull runs. The blue line represents the current bull run. And so you see it's sitting relatively amongst the pack and about average in what we've seen other 2+ year bull runs exhibit. We don't see any reason to expect the economy to sink into recession, nor do we see currently any warning signs that the bull market is over. And I will just add, duration nor magnitude are not good enough reasons to claim or ring the bell that this bull market is done. What history does tell us is that once a bull market makes it past its second birthday, it tends to run for multiple years. If you can bring up that second chart that I saw coming up as well, Nadine, this is from Carson Group, Ryan Dietrich, massive shout out to him, and he does an incredible job with this data here. But going back since World War II, the average bull market lasts for at least 5 years. and has gained more than 180%. We've currently seen over 500 trading days, and this current bull has performed basically in line with the average bull over the last 2+ years. Some stats here for you. I do love my data. 2 of the 11 bulls that lasted this long were within 1 year of ending. And historically looking, the other 9 would go on to last another 400 trading days. We find that year 3 of bull markets are typically rather weak, Nadine. They're up about 2.1%. And this is not a huge surprise given that what we typically see in year 1 of a bull market is a massive rocket, and investors are on the fence whether to believe it or not. And then we start to see consolidation come out in year 3, which is quite normal.
Okay, all right. So all of that being said, what are you recommending investors do right now? Should investors be taking profits in the names that have run? I'm thinking tech. Should they be building some more defense into their portfolio? What are you advising?
I think the reaffirmed uplift means that investors should continue to diversify. It's funny when we talk about it as Australian investors, we constantly talk about diversifying and not being so invested in our own backyard, given our home bias. The problem is that every country has the same thing. Every country has its home bias. So you talk to US investors, you talk to US advisors, they're doing the same thing. They're looking externally and offshore to rebalance their portfolio. But historically, Australia's been so overweight Australian investors have been so overweight to Australian names. I think looking at investing in those names or indices, if I can put it that way, that are relatively cheaper. If you're taking the punt on value or equal weight, you're starting to get some ride now. Unfortunately, Nadine, we talked about Nvidia last time. You know, that they just punched it up again over the last couple of weeks. It's really hard to keep on top of who's going to be outperforming and who's going to be underperforming. I mean, we continue to look to diversify. The breadth and spread of other sectors rising, as the Warren Buffett famous saying goes, a rising tide floats all boats. You should be a beneficiary there. I think taking profits makes sense and rebalancing. More specifically, though, you know, one of the things that we're talking to our retirees, those that may have a little less cash in the kitty, go and sell down, take the profits. We've been investing, we're sitting on large double-digit gains on some of these investments over the last 12 months. Go and spend the money, go take the holiday, go spoil the grandchildren and top up the cash. If you're accumulating and you're not in consumption phase, you just got to keep saving. You just got to keep dollar cost averaging and just keep buying and buying and pray to God that you get a bear market, because as we continue to see markets rising now, the only way you're going to get massive uplift is if you start continuing to invest on a downturn. Mm-hmm. But for everybody, the only thing I'd say, and the final bottom line is just go get advice from someone that can help you, that relates to your personal circumstances.